Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 29th of December 2019. And yesterday we produced two videos. Our Gold and Silver Weekly Update for the weekend in the 27th of December and our discussion with Journo Marcus entitled 2020 Brexit, US Trade and Media Bias. And we've placed links to both of these in the description box below. Now, during our update video podcast, we mentioned to look out for today's video, as we will be highlighting why the 31st of December 2019 will be an important day, potentially, for the US dollar and gold and silver prices. So let's now focus on why this is so. Back in September, the repo market went haywire, where rates being charged between banks rose from the normal expectation at or around 2 to 2.25% to as much as 10% at one stage. And this gained enormous international headlines. Now, we've produced a number of videos on repo, and we won't go over the same ground here, but again, we've put links to these videos that we produced earlier in the description box below. Anyway, the essence of it is that the Fed, the US central bank, started pumping in liquidity into this market to ensure that such rates would normalize, and that those banks and financial institutions requiring cash from the repo market mechanism to fund their short-term operations could adequately do so. Now, traditionally, the repo market comes under one of its most strenuous periods, that is, when banks and other institutions require the most cash, at the last day of the calendar year. Now, December the 16th, which has passed, saw a lot of pressure, mainly because this is the time that new US debt is distributed to investors and also quarterly corporate tax payments are due, thereby necessitating the need for greater liquidity. Well, so far, the Fed has managed to fund these operations, and now we have December the 31st staring almost imminently at us. And the question is, has the Fed created sufficient liquidity to prevent any of the institutions dependent on repo from failing to meet its financial obligations? Well, since September the 17th, the Fed has been injecting liquidity and embarking on major Treasury buying themselves. In excess of $320 billion worth of support had been given by the Fed, and it has obligated itself to continue with this liquidity expansion into the new year. Now, we should remember that the purpose of this excess broadly is to keep banks flush as they deal with month-end funding issues, corporate tax payments, and the deluge of Treasury debt being sold by the federal government to fund its deficit. Now, it was first thought that $250 billion would be sufficient, but the Fed's total support has already eclipsed this limit some 3 weeks ago, with the expansion of daily operations, the introduction of longer-term loans, and its balance sheet expansion through monthly Treasury bill purchases. Now, many YouTubers and pumpers are using this situation to claim that banks have run out of money and are on the verge of collapse. Now, the truth is, those who study this a little deeper and are perhaps more aware of how this system operates will discover that what is actually happening is that, yes, some are in a little difficulty, but the larger banks are just hoarding cash and have already admitted to the Fed that they have more than enough cash in excess reserves to meet regulatory issues and obligations. But they prefer holding that money at the Fed, where they can still earn around 1.5%, rather than in the repo market. And this has created a significant problem. In other words, some of the central banks that will be net contributors to the repo market to fund those other institutions that wish to borrow are not putting it in. Now this is the oncoming dilemma. If repo rates become jumpy again by the 31st of December, so we're looking at either tomorrow or Tuesday, and many fear this may happen, some of those leveraged investors may have to unwind their Treasury holdings, potentially increasing the US government's interest costs at a time of record borrowing. So you can imagine the turmoil that this would cause. Also, many analysts believe banks, particularly those in Europe, will withdraw or retreat around New Year's Eve from the repo market, driving up rates by pulling cash away from the system, as others try to secure financing. In other words, the demand for less cash will be greater, thereby pushing the price up. You see, European banks face slightly different capital rules, encouraging them to reduce their end-of-year footprint and the amount of equity financing they need to back up their assets. So they have no real need to place these funds into the repo market or to continue buying the assets within the repo market. So we get a potential double whammy. Now, our view is that the major banks, the major financial institutions are broadly okay. However, the same cannot be said for a number of hedge funds and independent broker-dealers who are some of the main users of short-term repos used to finance positions in US government debt. But they're not alone either. There are also cash buyers, such as mutual funds, foreign central banks and sovereign wealth funds, who buy the treasuries with money they have without any need to borrow. But leverage buyers, that's those who buy these products against borrowing money, have gained importance as others slowed their purchases. And we've all seen the headlines recently that a number of hedge funds have not only witnessed poor returns, but also capital withdrawals this past year, which just adds to their financial woes. Now, if hedge funds find that they're unable to purchase these treasuries or borrow monies that are required, and foreign banks and funds also withdraw or reduce, then the Fed is left holding the baby, so to speak, and has to take up the slack. This could have a most profound effect on its balance sheet. It already is starting to. And the repo market is the oil in the wheels of the Treasury market. Therefore, the Fed simply has no other choice but to purchase these unwanted treasuries. Now, our position is that the Fed has made allowance for this. And if, just if, one or two hedge funds fail, the contagion is likely to be limited, as the major banks are still protected and adequately liquid. But it will still have consequences. Now, if we are wrong and sufficient liquidity is not provided because either the Fed has made a mistake or the demand for additional monies is greater than anticipated, or others have withdrawn from the repo market more so than was expected. So if we are wrong and sufficient liquidity is not provided, short-term rates will skyrocket. The Fed and repo market will be in turmoil, and you will see a huge tailwind behind the price of gold and then ultimately for silver. So our view at this stage, and our recommendation, is to keep a close eye on the financial markets tomorrow and Tuesday, with particular emphasis on the repo market. And although we still believe things will be okay, we're not totally privy to any additional skeletons in the cupboard that may still be lurking. And assuming the 31st goes without incident, there is no doubt in our minds that it still will have been funded to a large extent by the Fed, thereby affecting its balance sheet further and causing some of the upset that many of the cynics of the financial system have been advocating. We still believe we are very far off any major collapse or any major systemic failure. However, these things, rather than just happen overnight, do tend, on occasions, to prove to be a slow but lingering death. Now, all of this can still be overcome through various measures that the Fed can take. But that said, there's no guarantee. And as we have said so often before, emotion, both fear and greed, play a very important part within our financial system and can often derail any plans that any major government, financial institution or central bank will have put in place to ensure a degree of stability. So the next 2 days, critically important. Thanks for listening. Rest assured we shall keep you abreast of developments as they occur. And please, if you haven't done so, kindly subscribe to our channel, press the bell sign so that you're notified of videos as and when they're published. And not forgetting to look at those videos we've placed in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.